Hello, welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. We cover key opportunities and risks for investors tied to developments around the world, and we take your live questions from the chat on YouTube so you can ask us what's on your mind at any time. Now, there's a few required disclosures before we get started. We don't know you personally, so we don't make personalized recommendations, but we do generally talk about what markets and sectors and areas of investing we think are likely to perform well or poorly and why, although we don't provide an outlook for specific stocks. Clearly, things can and do change, so all the thoughts we share are subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves, so please keep all that in mind for our show today. Now, as is the case every week, I'm joined by Michelle Gibley and Heather O'Leary on the global strategy team here at Charles Schwab. Hi, Michelle and Heather.
Good morning, Jeff. Good morning, everybody.
Good morning, Jeff. I'm going to be watching the chat and questions closely, and we'll get to those in a little bit. But what are we watching this week, Jeff?
Yeah, so I'll kick things off as I usually do with what we are all most focused on. Over 100 S&P 500 companies report third quarter earnings this week, and about 89 companies in the Stocks 600 index in Europe. So there's a lot going on. Of note are the reports from UPS, Norfolk Southern, and Southwest Airlines. If I had to pick three to watch, I might watch those most closely because they may reveal the combined business impact of Hurricane Helene and the three-day East Coast dock workers strike on the recent quarter, which we know can affect many businesses as we move through the quarter. So it'll be interesting to watch. On Wednesday, we're going to get the beige book from the Fed. This is something Fed Chair Powell watches very closely. It's kind of a collection of anecdotes from the 12 Federal Reserve districts, and they're likely to report also on disruptions from Hurricane Helene and Milton in the latest version of that beige book. In 2017, following Hurricanes Harvey and Irma, firms in several districts noted major disruptions in sectors including transportation and energy and agriculture. So we'll have to see what they have to say and what the lingering impact might be, at least as the fourth quarter got started. Also on Wednesday, after 25 basis points, three cuts of 25 basis points already this year, the Bank of Canada meets to potentially deliver a bigger 50 basis point rate cut. We'll have to see. The downside surprise in September inflation and the Fed's 50 basis point move last month gives the Bank of Canada cover to accelerate its own cutting pace. Still, a 50 basis point move isn't assured. The downside surprise in CPI was mostly due to airfares, and actually hiring surprised on the upside. So there's a bit of a battle in the data there. We'll have to see where they come out on that. But the Bank of Canada is certainly one of the more aggressive central banks among major economy central banks to be cutting rates. And on Thursday, China's banks are set to lower their prime loan rates. We saw some of that overnight, tracking the People's Bank of China's cuts to key rates at the end of September. So we'll have to see whether that makes any difference. We're not seeing lower interest rates entice much borrowing so far, with consumer and business confidence at record lows. Bank lendings continued to fall in China. Also on Thursday, we get the preliminary readings of my favorite economic piece of data every month. I watch this one most closely. It's the Purchasing Managers Index. That's going to indicate how economic and earnings growth is developing in the fourth quarter for the U.S., the Eurozone, France, Germany, India, and the U.K., Japan. A bunch of other big economies released this survey of business leaders. Incredibly important to watch that, again, as out on Thursday. And Michelle, last week, the ECB cut rates at a consecutive meeting rather than pausing. And we discussed that possibility last week. What's the latest for the Eurozone economy?
Yeah, the ECB cut because economic data and inflation has been coming in a little weaker than it had expected at its last meeting. You can see in the chart, Eurozone headline inflation for September came in at 1.7%. That's the lowest since 2021. The lower inflation figure is a positive, but it was flattered by the base effect of higher energy prices a year ago, which have since declined by 6.1%. So that was a big factor in the decline in headline inflation. If you look at core CPI, it came in at 2.7%, and that was led by services inflation at 3.7%. And that's still a little elevated, but it's been slowly moderating. Now, the ECB is expecting headline inflation to actually tick up in coming months as those higher base effects drop out, and because we have a union wage negotiations are kind of a staggered nature, and those will start flowing through Now, positively, they did say they believe inflation will fall back down to around 2% over the course of next year, and that's a little bit earlier than expected. Now, one reason for optimism is that the rate cuts already delivered and the expectation of further cuts is improving the economic outlook. Credit standards by banks are easing and demand for loans is picking up. In the chart, you can see that the demand for loans by businesses moved into positive territory, improving for the first time since the third quarter of 2022, and demand for loans by households also continued to increase. While the Eurozone economy has been weak, actually data has been surprising to the upside, notably German exports and industrial production, as well as consumer confidence in both France and Italy, and better employment figures in Italy and Spain. And the Eurozone is not the only economy where data is coming in better than expected. That's also true in the US and in Canada, and the announcements over China over the past month imply maybe an improvement in its economy over the near term. And recall for stocks, what matters more is better or worse. That matters more than good or bad.
Yeah, that's always an important point to remember. Right? Just reflecting back on what you said. So Eurozone inflation, just focusing on the inflation number, services for the Eurozone down to 3.7%, I think you said. That we wish we had that here, right? We're looking at like 4.75% or something here in the US. I think it was 4.7 is the latest reading for US services inflation. So much stickier in the US. One of the reasons why we're a little bit different trajectory there and pace from central banks. But yeah, very important to remember, better is more important than good when it comes to the market. Just trending in the right direction can be very good for equities. And on that point, since we're in the earnings season, I want to add some data on European earnings. So on the bright side, European earnings growth is expected to keep pace with the S&P 500 for the first time in a while. After last year's what I was calling a cardboard box recession, when it really hit the earnings of manufacturers pretty hard, manufacturing and trade fell into a recession globally last year. Those are more concentrated outside the US. You're going to see more representation in European indexes tied to manufacturing. But we're seeing a bit of a modest recovery on fairly easy comparisons to a year ago. Earnings growth very similar between international and US here for Q3 as we go through this earnings reporting season. Mid-single digit numbers, not great, but certainly better than a year ago for Europe and moderating for the US. But on the negative side, analyst earnings revisions are looking very weak this quarter. As we approach the rush of earnings this week, we've got analysts downbeat on prospects for earnings expectations in the coming quarters. The blue line here shows the number of upward revisions to earnings. This is actually the number of companies seeing upward revisions in the MSCI World Index. About 72% of the companies in that index are U.S. companies. So this is the U.S. as well as it is the rest of the world. We're seeing very few upward revisions. And we're seeing a normal number of downward revisions, the orange line. You can see the quarterly pattern in this chart that repeats and repeats and repeats. Well, at this point in the quarter, we'd expect to be seeing more upward revisions at this point. We're not. So that could maybe tell us two things. One, it leaves the potential for a lot of upside guidance as we actually get into the earnings report. So maybe a big bump up is coming, or maybe corporate leaders are going to be a little hesitant this quarter. Maybe they're going to give a little bit of a softer outlook as we go through the bulk of the earnings season, as they've been guiding analysts so far. And that could be a little disappointing over the next few weeks. So potential volatility as we move through these earnings reports. And speaking of that potential volatility, Michelle, I want to bring up China. You mentioned it earlier. China has also been, announcing a series of stimulus announcements that led its stock market on a wild ride this month. We've talked about it and the risks to investors getting too excited about the prospects with having this pattern of overpromising and under-delivering on stimulus in China that has again prompted a pullback in China's stock market from the latest run-up, as we warned was likely. But what's going on there? What can we expect going forward here? What should we be watching most closely here on China?
Earning is very inexpensive. So the bottom at 8 times is good, but we need to see the government deliver more effective fiscal stimulus in order to turn around consumer and business confidence. And that's what we really need to see for a sustainable bull market. And there's still the potential for additional fiscal announcements at upcoming budget meetings, either at the standing committee, either later this month or early next month, as well as mid-December, we get the Central Economic Work Confidence. In the near term, we could get some more volatility in both Chinese and emerging market stocks as we await more news about how China will get fiscal policy turned around.
Yeah, that's investors have been really focused on monetary policy this year with all the rate cuts, including those in China, but they might be missing what you just said there on fiscal policy. There is a drag on tighter fiscal policy, and not just in China. Of course, fiscal policy involves taxes and spending set by the government, while monetary policy involves moving interest rates and is enacted by the central bank, which tends to be politically independent. When they both move in the same direction, they combine to provide a potent boost or restraint to growth and inflation. And we saw that back in 2021 when central banks aggressively cut rates in response to the global pandemic, while governments approved new spending programs like tax cuts and large handouts that really drove large budget deficits. That year saw the strongest global economic growth and inflation in nearly 50 years. But then in 2023, we got the reverse of that. Tighter monetary and tighter fiscal policy contributed to a slowdown in growth and inflation. But when you've got fiscal policy and monetary policy conflicting with each other, going in different directions, the outcome's less clear. We've got the central bank of the world's second largest economy, the People's Bank of China, cutting its main policy rate. We talked about how they've been cutting rates here now for a couple times, back-to-back cuts here, and they cut the one-year prime loan rate again today. Loan demand remains weak, suggesting easier monetary policy is not reviving China's economy. In fact, the latest data shows that loan growth has decelerated to a new record low in September. Additionally, last week's money supply data showed growth slowing there as well. With less money moving around the economy, it just suggests that economic activity remains sluggish. And you've got consumer confidence near all-time lows in China. So there just seems to be little demand for borrowing by households or businesses, even at the lowest policy interest rates the People's Bank of China have ever implemented. So it seems that the easing of monetary policy is being undermined by an unintended tightening of fiscal policy in China. So the 2024 plan was for China's government funds budget to include 7 trillion in taxes and revenue and 12 trillion of spending. That's a deficit of 5 trillion, which would be a boost from last year's 4 trillion to provide like 1 trillion yuan in economic stimulus. But as of the end of August, the latest data we have, 2/3 of the way through the year, the deficit was only 2.1 trillion. It should have been 3.7 at that point. The sum of all this is that there was an unintended 1.6 trillion tightening in fiscal policy, and that acted as a drag on the economy, even as they were cutting rates, trying to accelerate the economy. So this net effect of easing monetary policy and tightening fiscal policy has been GDP coming in below the government's target of 5% this year. In fact, it was 4.6 for the third quarter. Tighter fiscal policy is also contributing to a weak outlook for earnings, while easier monetary policy has been helping to lift stock market valuations. We went from a PE ratio of 8, right, to about 11 now as of mid-October in the MSCI China index. So those two contrasting factors had actually almost perfectly offset each other and let the MSCI China index flat for the year as of September 9th. But now with all these new stimulus announcements, it's up about 20% this year as of mid-October, tied with that wild volatility amid those announcements, as you noted, Michelle.
Yeah, you know, that 1.6 trillion yuan below what they were spending, that's really a reason why people are looking for, you know, maybe at least 2 trillion yuan in additional policy to really get any kind of positive impact on the stock market. You know, and it's not just China where fiscal policy is tightening, it's happening in Europe too. We're seeing that contrast between monetary easing, you know, with ECB cutting rates for the 4th time last week, and the potential for a rate cut every meeting through mid next year. But at the same time, fiscal policy is tightening.
Yeah, and it's not just, and so I think to some extent, investors, maybe over the coming 3, 6, even 9 months, might be making a pivot from focusing on monetary policy because now all the major central banks are cutting. They're cutting on a steady path. And that's kind of boring at this point. We know this. This is already priced in. What I think they might begin to recognize is that fiscal policy is getting tighter, and that's an offset to this, right? So you've got in the US, not necessarily the case. US budget deficit is soaring. The CBO is forecasting it'll remain above 5% of GDP every year over the coming decade. But there does seem to be a more effective debt ceiling that's been reintroduced in Europe, where governments have to adhere to budgets of 3% of GDP, a budget deficit of 3% of GDP. And we've seen plans in recent weeks begin to show that the largest Eurozone economies will also be pursuing tighter fiscal policies. It's not just China over the course of the next year trying to rein in their budgets and meet that target. Now, Germany holds itself to a higher standard. It wants a structural budget deficit of basically zero, no deficit at all. So they're pulling in spending a little bit to comply with that. In France, where budgets are excessive right now, the new prime minister has announced spending cuts and new taxes, despite those being initially objected to by some of the members of the new government. They seem to be supported, and so we'll see the budget get reined in there. In Italy, same thing. A right-leaning government with a lot of spending plans, but pulling that back in. The Italian deficit is likely to come in down from 3.8% this year to below 3% by 2026. So tightening those budgets, reining in those deficits, and that fiscal tightening in Europe would result, based on my estimates, a drag on GDP of about 0.5%. So 0.5% shaving off of GDP what it would otherwise be if they weren't pulling these budgets in. So you think of stimulus from easier monetary policy, but a drag from tighter fiscal policy. This drag's probably not enough to tip Europe into a recession. It's only maybe a 0.5% drag, but it will probably keep below average growth in place there. In fact, the IMF is forecasting 1.5% growth in GDP for Europe's economy in 2025, contrast the 1.9 forecast for the US. So tighter fiscal policy points to an outlook for also weaker earnings growth, maybe just single-digit weak earnings growth, below average earnings growth for European companies in 2025. You normally earnings recession in many of the last 4 or 5 quarters. We're only starting to see a recovery, yet next year earnings growth may actually be just single. Conflict between tighter fiscal policy acting as a drag on earnings growth and easier monetary policy potentially lifting valuations might net out, but it might actually net out in a positive way for investors in Europe because earnings expectations are already low. Analysts are not predicting, double-digit gains next year, big, powerful rebound that would then disappoint expectations. Are actually only forecasting single-digit growth in the coming quarters. So those sober estimates for earnings, kind of reflecting this tighter policy, combined with easy comparisons to a year ago, suggests, I think, less potential downside of the outlook for earnings growth. But at the same time, we might see stock market valuations offer some upside. Valuations in Europe are kind of in line with their longer term averages. And if you look back to 0809 or 2011 through 2016, the last 2 times the European Central Bank was cutting rates, we saw a big rise in price earnings ratios. So that could be a good news for the stock market performance in the coming year, Michelle, as we get this combination of, yes, lackluster earnings growth, but an uptick in PE that could maybe boost returns there.
Yeah, another point is you were just mentioning, fiscal policy being tight can be a drag on growth in the short term, but it can actually benefit long-term growth and keep a check on inflation. It could reduce the risk of a crisis and, potentially result in less crowding out of business investments. And that could also benefit valuations in Europe, even if earnings are soft in the near term. You also spoke about performance. I think international stocks actually outperformed U.S. stocks in the third quarter.
Yeah, they did. As a matter of fact, they're a little softer here in October relative to the U.S., but I got to wish the bull market a happy second birthday. It began in the middle of October last year. It began after U.S. and international stocks bottomed in mid-October of 2022. They fell about 25% from the start of 2022. It peaked in January, bottomed in October after about a 25% decline. And over the past 2 years, U.S. and European stocks have produced powerful gains, but Europe has outperformed over that period of time. The chart shows the total return in US dollars for the MSCI EMU index, which tracks stocks in the European Monetary Union, or as we call it, the Eurozone, and the S&P 500, and then the S&P 500 Mag 7. I always like to show that as well. The performance gap has been narrowing against the S&P 500. So the orange line, the S&P 500, has been catching up to the green line, the international stock market, or the European stock market, but not against the S&P 500 Mag 7, where it remains very wide. And this illustrates the broad outperformance by the average European stock over the average US stock so far this bull market cycle. So nice to see that outperformance after a long period where European stocks had lagged. All right, Heather, let's see what's going on with the chat, the Q&A. What's going on?
Well, it looks like the election is at the forefront of our viewers this week. As we discussed tightening fiscal policy, could you discuss any tariff impacts on the global economy if, certain candidates become elected?
Yeah, so I'll start off by, before I get into tariffs, just talk about fiscal policy in the U.S. Budget deficits are wide. They don't appear to be getting reined in. And I'm not sure it matters who wins the Oval Office. We're very likely to have a divided Congress, right, between the House and Senate in the hands of different parties. And the consequence of that is don't expect sweeping tax policy changes or other legislative changes that would affect, big spending programs or big tax programs. Just not likely to get through what's likely to be a divided Congress and maybe very close margins in some of those. So I don't see that. I just don't see fiscal policy is changing dramatically in the U.S. despite whatever the election outcome turns out to be, just given the very likely outcome there in Congress. On fiscal policy, though, so the White House does have a lot of say over defense and trade policy, things that international things. And so, we'll have to see what happened on the defense side. But in terms of trade policy, we could see more tariffs. Both the first Trump administration and certainly the Biden administration has been very pro-sanction, very pro-tariff. And so we'll have to see where that goes. That does affect markets because a lot of big companies, including many we think of as classic American businesses, do get a lot of international sales. And they could be facing counter sanctions, right? So if we apply or counter tariffs, if we apply bigger tariffs on China, companies that sell to China may see Chinese tariffs applied to our products as they try and sell them in their markets. Remember, big companies like GM and Nike and Intel get 25% or more of their sales from China alone. So that could have major ramifications on their outlook for revenue and earnings growth were they to be implemented. And then talking about tariffs beyond mere China tariffs. There's talk about tariffs on Mexico or Canada. Those are our two bigger trading partners than what we trade with China. And that could have a more substantial impact. So there's some risk there that we would see some major trade issues that could affect businesses in terms of their supply chains and also their end product sales. So it's something we'll have to watch closely. In general, around the world, we've seen this rhetoric among many of the parties that won big in elections over the course of 2024. A lot of my country first policies talk about tariffs. We didn't see much of that implemented. In fact, in many cases, we didn't see nearly any of the campaign promises that were talked about during the campaign actually implemented once those parties took office. I know it's still early. We're talking about 2024 elections here, but some of them even took place back in January, May, April timeframe, and we really didn't see much enacted. The reality of international relations, trade policy, supply chains, maybe make the bark of those campaign promises a little more than the bite of what actually happens once they get in office. Now, I'm not sure what can happen here. Your guess is as good as mine, but certainly tariffs will be one thing we'll be watching as a result of this election. Do they change dramatically? If they do, what businesses will be most affected? It is worth noting that more trade-sensitive businesses have actually done better over the last several months. We've seen those companies with a higher percentage of international sales outperform those with a lower percentage of international sales. So it seems like markets are not bracing for a major ramp up in trade risks, but it certainly is on our radar screen.
Yeah, I'd add to that is, as you mentioned, bark versus bite. A lot of times what happens on the campaign trail isn't necessarily what ends up enacted as policy. And we don't even know, let's say for Trump, the talk about tariffs is really just a negotiating tactic, and maybe he makes a deal. We don't really know what the outcome will be of all of that. And what we really can say is that it's likely to create some volatility in markets because we don't know that uncertainty. For stocks, they don't like uncertainty.
And let me just have you follow up on that, Michelle. So I know you've done some work looking at the inflation impact of tariffs. What's the takeaway from that? I mean, do we have to worry about a big ramp up in inflation if we do see tariffs put in place?
Yeah, it's tariffs would be inflationary because it does, usually pass through to the end consumer. But we're not expecting a big increase in inflation like we saw during the pandemic. There was really just like a perfect storm of, supply chain issues and disruptions in labor markets. But the impact, and you mentioned it too, it also depends on what the countervailing tariff actions are, what happens to demand. If it's a big increase in price, demand might go down, and so the price doesn't actually flow through. It's just really some uncertainty right now.
Yeah, makes sense. Okay, Heather, what else is out there?
Thank you for that. Just as a follow-up, do we have a perspective on exactly how much manufacturing is actually being exported versus imported, and how the supply chain diversification might go ahead and change any impacts that tariffs would have?
So when we look at the companies that are in the S&P 500, we're really talking about big manufacturing exporters. We're talking about airplanes and satellites and, pharmaceuticals and, excuse me, really high value added manufactured goods. When you talk about smaller manufacturing businesses that are more domestically focused, they're generally not in the S&P 500, right? They're smaller businesses. Maybe they're not even small cap companies. And so what we tend to see is very globally exposed manufacturing businesses, automakers and the like. So yeah, what percentage of their sales really depends a lot. Caterpillar, a lot, right? And so Intel, certainly a lot of these, you see a lot of international exposure, some maybe a little bit less, but it's going to vary across the product mix, but it is fairly high for manufacturers in the US. The percentage of international sales is big because the stuff we make really well, and we're generally the global leaders at, and they're in high demand. So it is a high percentage of sales for a lot of U.S. manufacturers when you look at international, and they're two big businesses, or they're two big businesses in big countries, right? So they tend to be sold to European buyers, Asian buyers, and so if we were to see big countervailing tariffs, it could be fairly disruptive to a lot of those big U.S. manufacturers.
Thank you for that perspective. Another question that we have from Carol is reminding us about Bitcoin. There was a lot of hype about it, but it seems to have calmed down recently. Do we expect any policy changes with regard to cryptocurrencies?
Oh, well, it seems that President Trump is more favorable towards cryptocurrencies and adopting them and using them than the Harris administration. But we'll have to see. I think the Fed is on a path towards introducing a Fed coin and a way of transacting through a blockchain that still utilizes the dollar. So we'll have to see what that kind of competition that might bring. It still seems that Bitcoin is not that much in use as a currency. It's more of an intangible asset, and generally retained its value in the markets. It's sort of interesting to see the shift towards intangible assets in some parts of the investor universe. So we'll have to see where that continues to develop. Obviously, there's potential big moves one way or the other with regard to what happens in terms of the election here in November. I'm not sure longer term it changes the adoption case for Bitcoin. I think we've continued to see rather slow pace of adoption there as a currency, but certainly more and more interesting as an asset and a longer term asset class.
Thank you. So you mentioned Bitcoin as being more of an asset than rather a currency. What about other hard assets? Do we have any perspective on gold, silver, copper, and the like?
Yeah, a great question. So gold, I think, has been moving up just on concerns over geopolitical risk and political risk. we might see post-election gold pull back a little bit. That would be just classic, move in gold acting as a safe haven. And then once the election outcome is over, no matter what the outcome is, some of that risk, some of that hedging comes off. There is, excuse me, stronger demand for gold coming out of, the biggest consumer in the world, which is India, which a lot of gold, 70% roughly, is used for jewelry. And there's still solid demand there, even if it's a little softer in China. So demand for jewelry, demand for it's definitely used in semiconductors and other electronics. So there's some demand there as well. So fundamentally, there's some demand for gold. But in terms of as a geopolitical and political hedge, could see a little bit of a pullback here. Maybe a ramp up going into the election, but maybe a little bit of a pullback afterwards would be the classic thing that you'd see with gold. Other assets, commodities, you'd really want to see more of a ramp up in Chinese business activity and more inputs of commodities to really see more of a sustainable ramp up in other hard assets. And that might be a little further out on the curve than over the next quarter or so.
Yeah, I'd remind us that, we don't really want to see more building of property in China. They really have an excess of building. So that's probably unlikely. They could have some infrastructure spending, but I'm a little skeptical that we're going to see a big increase in demand for industrial metals.
Yeah, finally, I just quickly add that oil is really very much another geopolitical hedge. We're about $70 on oil now for West Texas Intermediate. It ramps up whenever there's a flare-up in the conflict, comes right back down again, just given abundant excess supply and fairly lackluster global demand. So we've still got that supply-demand mix in favor of prices remaining towards the lower end of their $65 to $85 range.
Great. Well, thanks so much. I think we are out of time, though, Jeff and Michelle.
All right. Well, thanks so much. Thanks everybody for your questions. I really appreciate that. Thanks, Heather, Michelle, our producers, Andrew and Gabe, and everyone for the questions and joining us. Tune in each week at 11 a.m. Eastern to catch the show or to catch the replay on YouTube. Also, be sure to click like on the show and share your comments on what you're watching in the markets, and we'll see you next week.